These are my 3 favorite ETFs for passive income in 2025. I already made a video talking about dividend stocks. I already made a video talking about REITs, and you can check out these other videos on the card above. But if you've already watched these other videos, you know that I'm going to explain everything about ETFs, tell you the pros and cons, and then give you my list of 3 of them to analyze. And I'm not going to ask you to like it now, but if you go to the end and like the content, don't forget to show your support to help the channel grow. That's all, and let's go. First of all, what's an ETF? Imagine buying a sample pack of ice cream flavors, all in one go. And you can try a little of everything, knowing that you will like at least one of them. And even if another one is bad, it will still be worth it. Each flavor represents a different company. So instead of picking individual stocks, you'll buy one ETF and automatically own a piece of every company in that basket. ETFs are traded on stock exchanges just like regular stocks, which makes them super easy to buy and sell. Now, talking about dividends, with dividend-focused ETFs, you are essentially getting a little bonus cash every few months. Work like this. The companies in the ETF pay dividends. The ETF collects them and then passes on a portion of that money to you. It's very simple. You can choose to pocket that cash as extra income or reinvest it to buy more shares, helping your investment grow over time. Your dividend payout depends on how well the companies in your ETF are doing. If they're performing well, you see those dividends adding up. Now, making our little list of pros and cons, one of the biggest advantages of ETFs is diversification. Instead of putting all your money into one company and hoping for the best, you spread the risk across many. If one company underperforms, others in the ETF can help balance it out, reducing the impact of a single bad investment. Investing in ETFs also requires less effort compared to picking individual stocks. You don't have to analyze every company or monitor market trends daily. The ETF does exactly that for you. Another advantage is the ability to reinvest dividends automatically, allowing your investment to grow over time through compounding. But on the downside, dividend ETFs tend to prioritize income over high growth, which means they might not perform as well as high growth stocks in a booming market. There's also the risk of dividend cuts. If the companies in the ETF decide to lower or stop paying dividends, your payouts will drop too. While ETFs generally have lower fees than mutual funds, some do charge management fees, which can eat into your returns over time. Taxes are another factor to consider since dividend income is taxable, meaning you will need to account for that when planning your finances. And even though ETFs help reduce risk through diversification, they still follow the overall market trends. If the market takes a hit, your ETF will too, even if it's structured for stability. I believe the pros far outweigh the cons, making this type of asset a valuable addition to a portfolio. But of course, that's just my personal opinion. And that said, it's crucial to choose wisely, understand exactly what you are investing in, and have a clear strategy. Investing blindly is never a good idea. You need to know where you are going and why. Now, moving on to my list, and just to be clear, this is not a recommendation, guys, just sharing my perspective. There are just some interesting options for you to learn about, study more, and even understand the asset in practice. And oh, I almost forget to mention in the whole video that these ETFs pay monthly dividends, but that's not always the case. Some pay quarterly like REITs, and that said, let's move on. The first ETF is SDIV, or Global X Super Dividend ETF. This ETF is designed for those of you chasing high dividend yields from a global perspective. SDIV invests in about 100 of the highest dividend-paying companies from around the world, which means you are not just relying on US stocks. You are tapping into a diverse range of markets. For example, SDIV's portfolio has included companies like China Mobile, Limited, a major telecom player in China, Banco Santander S.A., a global banking giant from Spain, Vodafone Group plc, a well-known telecom provider from the UK, and ENI-SPA, an Italian oil and gas company with a solid dividend history. These examples highlight the ETF's strategy of sourcing income from different regions and sectors. One cool thing about SDIV is that it aims to pay out high dividends, typically on a monthly basis. That steady stream of income can be a big draw if you're looking for regular cash flow from your investments. However, it's important to remember that high yield can sometimes mean higher risk. Some companies might be offering big dividends because they're operating in more volatile sectors or facing unique challenges. For example, in 5 years, the SDIV prices fell 58.6%. In 1 year, grew 3.93%. And in 1 month, it grew around 1%. So there is volatility, okay? The dividend yield of this ETF is around 10.89%, and the current price is around $21.32. What that means? If you invest $1,000, you receive about 108.90 per year, which is roughly 9.08 per month. If you invest 100,000, you see around 10,890 per year, or about $907 per month. And if you invest 1 million, that's approximately $108,000 per year, equating to roughly 9,000 per month. Now, the second ETF is GPIQ. This is the Goldman Sachs monthly dividend ETF with a high yield. It invests heavily in NASDAQ, which means you get exposure to huge technology companies like Apple, Microsoft, Nvidia, Amazon, Meta, and Alphabet. This ETF is a solid pick if you're looking to tap into the tech sector while enjoying regular income. Every month, you get a piece of the action from these industry giants, giving you a steady dividend stream. What makes GPIQ even more interesting is its focus on quality tech names that have proven themselves over time. While tech stocks can be a bit more volatile, these big players tend to be more resilient and offer the potential for growth alongside their dividend payouts. It's like having your cake and eating it too. Regular income and the chance to ride the wave of innovation. And since it's an ETF from a well-known company like Goldman Sachs, you can put a little more trust in it. This reputation not only boosts confidence, but also reflects a certain level of rigor and oversight in how the ETF is managed. In addition, GPIQ's monthly dividend distribution provides a more frequent cash flow compared to quarterly or annual payouts. This can be particularly appealing if you're looking for a steady income stream to reinvest or supplement your regular earnings. With the tech sector showing continuous innovation and growth, GPIQ offers a way to participate in that dynamic market while reaping the benefits of consistent dividend payments. With a price of around 49.52 and a 9.9% dividend yield, here's what you could expect. If you invest $1,000, you receive about $99 per year in dividends, which works out to roughly $8.25 per month. If you invest $100,000, you earn approximately 9.9K per year, or about $825 per month. And if you invest $1 million, that translates to roughly 99K per year, which is about 8.2K per month. And now the third ETF is QQQI. The new NASDAQ 100 High Income ETF is changing the game for investors who want NASDAQ 100 exposure, but also crave high monthly income. Unlike traditional NASDAQ ETFs that focus purely on growth, QQQI uses a covered call strategy, allowing investors to collect a hefty 14% yield, a rare feature for tech-heavy funds. But how does it work? Instead of relying on dividends, which most NASDAQ giants don't pay, this ETF generates income through an actively managed options strategy while still holding major growth stocks like Apple, Nvidia, Microsoft, and Amazon. The core of this strategy is selling covered calls options, which allows the fund to earn options premiums regularly. A covered call strategy works by selling call options on stocks the fund owns. And if the stock price rises significantly, the fund may have to sell shares at a predetermined price, capping potential gains. However, if the stock remains stable or declines, this ETF still collects the options premiums, ensuring consistent income. This approach makes it an attractive alternative for those who want to benefit from tax sector gains without sacrificing cash flow. This makes the yield more sustainable and less dependent on market conditions. The fund's managers adjust the options they sell to maximize returns without compromising growth potential. With a price of around $53.24 and a 13.76% dividend yield, here's what you could expect. If you invest $1,000 and looking on the past, you would have received about $137.60 per year, which works out to roughly $11.47 per month. And if you invest $100,000, you would earn approximately $13.7K per year, or about $1.1K per month. And if you invest $1 million, that translates to roughly $137.6K per year, which is about $11.4K per month. And that's it, cousins. What did you think? Are you thinking about putting dividend ETFs in your portfolio? Tell me in the comments. Bye bye.